Okay, let's press on. Now I think we're down to, in terms of actual class attendance, the true members of the cult. We have finally established who you are. This is about right. So everybody else is watching it on video while we enjoy the special privileges of all being together in the same room. This is a slide I had hoped to show you on Monday. And in fact, I was working with a version of the PowerPoint that was conflicting because I use Dropbox, and that's a problem when you use Dropbox. So I'm going to show it to you now and not say much about it because it's ongoing. And I guess what we'll do is say more about it when it becomes resolved as to what's going on, because that is still undetermined. But this is the slide I wanted to show you. And you, again, unless you've had Econ 53, you don't know what's really being discussed here. But the overnight borrowing cost of so-called repurchase agreements is reflective of the effort of banks to borrow federal funds from each other to meet their reserve requirements, if you remember what that is from Econ 53. And because of the Federal Reserve reaction to the mortgage crisis in 2007, 2008, and the programs that followed, such as quantitative easing 2 and quantitative easing 3, at some point, the Federal Reserve System had created $2.6 trillion in excess reserves for the banking system. And I made a big deal about that in Econ 53. And they have since pared that back down to about $1.7 trillion by slowly conducting reverse open market operations and the like. But nonetheless, the banking system is absolutely overflowing with free reserves compared to any time in the historical past. And so when any bank needs reserves for any reason and wants to borrow it, they borrow it in this market. They either borrow it in what I was referring to last year as the federal funds market, or a linked market, which is this market, which is the repurchase agreement market. It's called a repurchase agreement simply because the Federal Reserve System will lend reserves to the system on a 24-hour basis and then expect the loan to be paid back. And because the loan to be paid back is collateralized with Treasury securities, it technically is called a repurchase agreement, but it's simply a 24-hour loan that is collateralized. So when banks want to borrow their reserves because they have a reserve shortage because of whatever activity they're conducting, then it should be very easy for any bank to borrow reserves at rock bottom rates, because $1.6 trillion for the system exists there that normally sit idle, not borrowed or lent by anybody. So if a small bank in New York wants to borrow reserves, they should be able to borrow them at the 2% or so, or 1.7% annualized rate. But as I said, all of a sudden, unexpectedly last Thursday, that rate went to 10%. It has never been that high. It is not even that high during the mortgage crisis. And so it represents normally an acute shortage of reserves where banks are simply unable to borrow reserves from anybody. Well, this is completely mystifying because of the fact that $1.6 trillion in free reserves are out there, so why can't they borrow from that market? Now, normally it's an indication, if you see it happening and there's no explanation, of a troubled bank, or 2 or 3 troubled banks who are having trouble meeting their liability obligations, and then the rumors floating around that that's true, so the markets freeze up that lend to banks in general for interbank loans. But there has been no rumors of any such arrangement or any troubled bank, and this is 5 or 6 days after the fact, and still no rumors have emerged, and normally by now we would know. I mean, after all, last week it was suggested that some obscure intelligence operative had filed a small report suggesting that there was some kind of impropriety conducted by a senior official in the United States in conversations with an official overseas, and that's a rather vague rumor. And within 24 hours, it was completely understood by the entire world that they were talking about Donald Trump talking to the president or the newly elected of Ukraine. and what the rumor was about, and so forth and so on. So if there was a troubled bank out there within 24 hours, given how fast news spreads these days, we would know who it was. The operation continues. Yesterday they did an additional $40 billion in excess in reserve purchases or reverse open market operations. And as commentators are saying today, it looks like they've simply re-established a quantitative easing program that is ongoing, that is larger in scale than any quantitative easing program that has ever existed before, including quantitative easing 2 and quantitative easing 3, which were launched at the height of the housing crisis. And nobody has the slightest idea about why they're doing it. And I don't have any idea about why they're doing it unless there is indeed some troubled institution out there. But the only troubled institution I can even think of is SoftBank, because, and they are, in fact, I think, going to potentially come close to failure because of the, I think, likely failure of the WeWork IPO, which is an ongoing saga, as I'm sure you're reading it these days, because they fired the president yesterday, so he's gone. And they laid off 5,000 people today, so they're gone, and the like. But SoftBank's not large enough, I don't think, to trigger off a crisis of this level. So we'll just wait for a while and see why the Federal Reserve has quietly re-triggered quantitative easing 4 and why anybody thinks that's necessary. Well, it's definitely necessary. Otherwise, these interest rates would be going up into double-digit ranges. So they're doing it to keep those rates down, and how it is to be explained. What's super weird about it, it's getting zero media coverage, and it is actually extremely important. There's only Wall Street Journal, Financial Times have an article about it every day that's short, offering no explanation other than the standard official pattern, which is never an explanation about it, saying all the same thing. It has something to do with end-of-year corporate tax payments or something like that, and it has nothing to do with that. It's too large to have anything to do with that. So I guess at some point we'll just watch it and try to figure out what it implies and what it means and why it was done. So the other thing I wanted to show you that I forgot, that I keep trashing Robinhood because I know a lot of you use Robinhood because it's free and you can open an account for $50, whatever, and trade little tiny trades on Robinhood, and you can use smartphone to do it and the like. And so, of course, I say, okay, fine, if that's how you want to get your feet wet in the stock market, go ahead and use Robinhood, but I don't regard them as a very reliable broker. This was a set of comments from last year where they commented that Robinhood, of course, sells their order flow to whomever pays the most for it, and that's because these market makers that are using the spread arbitrage operations that I described in the last lecture, of course, make a lot of money if they get market orders coming from order flow, right? Because if you actually do control best bid or best ask, or both, then when a market order comes in, then it's executed for you at your price. And if you get one on both sides, a buy and a sell at the same time, then of course you simply get the spread on whatever it is you're doing. So these big firms will pay for that order flow. The limit orders don't do them any good to get that. So, and of course, Robinhood sells everything they get. So if you are using Robinhood, then use limit orders exclusively, because that means that you will at least get the price by law that you set, because they have to comply with your limit order. But if you use market orders, there's no guarantee in my mind that you're getting anywhere near best price. And this article pointed out from Banyan Hill that for whatever reason, Robinhood makes more money for their order flow than anybody else does who does it. They're being paid more for their order flow. And comparing, for example, to TD Ameritrade, who did for a long time run a free site that sent order flow out for the highest bidder. And so I wrote here last year in Reddit, this, you can barely read it, I said to somebody that said something in Reddit, trading firms that specialize in spread arbitrage are willing to pay for order flow from Robinhood because a high percentage of the orders are market orders rather than limit orders. If these high-frequency trading firms are effectively at best bid and or best ask, their in-house limit orders get cleared. That is basically a market maker's dream. There is no disadvantage to the small trader sending market orders to Robinhood instead of, say, TD Ameritrade.
if there is no real disadvantage to small traders to use market orders through Robinhood, except they might be able to get a better price than they had used limit orders properly. And if you use limit orders at Robinhood, none of this is relevant. You don't care if the order is routed or where the order is routed. Take away use limit orders from trading at Robinhood. So that's what I posted on Reddit last year, and that tends to be true. Now, it may be when you post limit orders, you can often beat your limit order, and that happens to me all the time. And usually it's only by a half cent. So if you send a limit order to buy for $11.55, you'll often see it executed at $11.54.5. In other words, they literally trade at half a cent. Now, that's not going to do you any good, obviously, half a cent per share, unless you have 10,000 shares or something. But nonetheless, it does mean that it's possible to get a price that's actually better than your limit order price, and that's not going to happen for a limit order with Robinhood. But that has no practical significance if you're trading 100 or 200 shares, obviously. And you're not going to be beating it by a dime or anything like that. So that's what I had to say about Robinhood. Their reporting compliance and so forth is often questioned. And they're terrible for option trades because in option trades you have to have a brokerage that is willing to handle assignment well. And Robinhood doesn't handle assignment well. An assignment is when somebody else decides to exercise their option arbitrarily. And so the broker really has to be working for you when assignment is going on. And you see a lot of complaints posted on Reddit about how people thought they were screwed by Robinhood on options assignment. What that means we'll see a little bit later on. Now, we're going to finish off the rest of this by going through the second half of the material that's presented in Chapter 4. And then, as I said I'm going to also post up about a 20-minute extension about the crash in the year 2000 for the reasons that I said. First, I wanted to talk a little bit more about this odd topical event, and I spent almost 10 minutes doing that. And I also wanted to expand what I have to say about the 2000 crash because I don't want students to lose their memory of that event. I want you to understand a little bit in detail about what happened in the year 2000 and 2001. And so I'll post that video tomorrow. It won't be very long, but it will be part 3 of this, and it will be mandatory that you watch it. I decided to wait until after today because I wasn't quite sure where I was going to finish up today, and so I want to make sure I get everything in that I don't cover in the present lecture. So let's go to where I left off, and we were talking about, let's see, we had, the portfolio effect. I had shown you this slide here. Here we go again. This is artificial intelligence at its worst. Constantly overriding my decisions, thinking that it's smarter than me. I notice increasingly that as they come out with newer versions of Windows 10, that if you continue to use Windows 10, at some point you're going to have to buy or acquire all apps through the Windows Store, all of them. And that's true for Windows S Edition, but I notice they're also talking about doing that for Windows Pro in the next iteration coming around. So that's a nightmare come through, so you might as well stop shopping for your alternative operating system now. All right, we're all on the same page here, so let's get this up and running. Now, I showed you this, and I had made the point, without really explaining it very well, that the stock market doesn't do well during high periods of inflation, and this was the evidence that showed that in the episode of inflation during my lifetime, the so-called double-digit inflation with double recession, that the Dow Jones Industrial Average, although the volatility is clearly connected inversely with the inflation rate when you look closely at this graph, to some extent at least, it never rose, and given that prices rose during this period, the purchasing power of 100 shares of stock actually was cut in half, more or less, since the nominal value didn't rise and the purchasing power of the dollar value actually fell in half. Now, I had stopped on this, and I said I would come back and explain it, and I do expect you to understand this, and there will be a question about this that has a heavy weight
or a couple of questions about it that adds up to having a heavy weight because there's more than one question on the exam. Because I think it's important you generally understand the portfolio effect, and this is the first introduction to it. We'll see it time and time again, and specifically the application of the portfolio effect to issues of inflation. So we're saying here that in normal times, if you look at the graph on the pie chart on the left, that the diversified investor with a big mutual fund portfolio, or even the institutional investor, might have a mixture of 70% stocks, 30% yield-bearing financial assets like bonds, U.S. Treasury securities, and the like, to have a diversified, low-risk, high-yield portfolio. If that same investor, especially if it's a rational, well-educated investor, begins to suspect that we're going to enter a serious period of inflation, then gradually that investor is likely to shift the portfolio away from stocks and more in the direction of yield-bearing financial assets like bonds. As it says down here in the yellow box, during inflationary periods when nominal yields are high on bonds, or during periods of serious economic uncertainty, it also happens then, investors may rebalance their portfolio in favor of safer bonds. Now, by that I mean mechanically, if you have access to a mutual fund, as we'll see in the next section of the course, that means you log in, you open your fund account, and you sell off some of your stock funds and use the proceeds to buy bond funds. Or if you're doing it at an institutional level, because you're managing Harvey Mudd College's and CMC's endowment, which is done jointly now by a large investment committee. The endowments have been merged for the last 2 years. You may decide to shift the investment portfolio of the endowment a little bit away from stocks and a little bit more in the favor of bonds if you were trying to flee risk. Now, and this is why the stock market goes down. Now, in our first application of the supply and demand model that was explained in Chapter 3 and that you should now understand, when you take a look at the stock market that's represented on the supply and demand model on the left side, you remember the demand curve for a stock or for an index is simply the amount of that stock that would be demanded at various prices, with the negative slope, of course. And that's easy to understand, but the supply curve has a special definition that's not like the supply curve for a commodity. The supply curve represents an inventory that is held by people who currently own that stock, and so it represents their tendency to want to sell it at ever higher prices, and so the supply curve for a financial asset has a positive slope because it represents a rundown in inventory of that asset by present-day holders of the asset, as was explained in Chapter 3. So if there is a surge in expected inflation or an actual surge of inflation, first we might explain it by moving over to the bond market and asking ourselves about the supply and demand for bonds. And that's just another market. They follow this. We go through mutual funds next and ETPs, and then we go to bonds. And when we look at bonds, they'll be just like stocks, supply and demand, price goes up, price goes down. Same kind of market, bid, ask, limit orders, the whole works. It works exactly the same way. But we're saying that when there is a rise in interest rates, there's an increase in the demand for bonds. And that's being shown on the graph on the right side. We say, let's sell off some of our stock portfolio as represented on the left side, and we use the proceeds to buy bonds to add to our bond portfolio, which is shown in the graph on the right side. And so these two are connected. It reflects a portfolio shift that is taking place at an individual level, at an institutional level, at a national level, and probably at a global level. That, in other words, it's a micro phenomenon all the way up to an aggregate global phenomenon. And a lot of market behavior is herd-like this. And so investors rebalance portfolios away from stocks to higher yield bonds. Supply of stocks shift outward, lowering their values,
as does demand for bonds. Now, when, as we'll see later, a bond's value increases in the secondary market, its yield decreases. And so that's if it is is stimulating. But as the interest rates rise, then once we see that rise as a market rate, then our demand for that asset will respond to that increase in the interest rate. Now, the conspicuous feature about bonds and notes, as we'll see when we get to that section, is that nominal or market interest rates will always be above the inflation rate, because the market will drive those interest rates above the inflation rate. And so the real rate of return on a bond will always be either zero or slightly positive. So if the inflation rate goes to 6%, the 10-year note rate, for example, will go to 7%. And if the inflation rate goes to 12%, the 10-year note rate will go to 13%. And if the inflation rate goes to 18%, the 10-year note rate will go to 19%. So Treasury securities, at least, will have their yields always follow the inflation rate, but there's nothing to guarantee that the same phenomenon will happen with stocks. So people flee to the yield that is guaranteed to rise to reflect the inflation and abandon that component of the financial markets where there's no such guarantee. So stocks are sold off and bonds are bought, and that portfolio shift, therefore, causes the stock market to go flat. And we'll see numerous examples of that. And that's why stocks don't do well during inflationary periods. And keep that in mind, because you'll see an inflationary period, perhaps one that's rather substantial in your lifetime. You'll probably see at least two in your lifetime where you'll be a witness and live through episodes of double-digit inflation or potentially inflation rates that are higher than that. When that happens, you don't want to have your wealth invested in the stock market at the time. You need to flee in the direction of more secure short-term yield-bearing assets and not lose all of your purchasing power in stocks by failing to recognize this connection we're talking about. Okay, the next issue that we raised in Chapter 4 was the so-called river of money. And that's my own term, and I use it as a metaphor to describe what we're describing here, to apply to what we're describing here. And that is the combination of net new cash flow to mutual funds and net new cash flow to exchange-traded equity funds, which one is represented on the first graph, the other is represented on the next graph. Again, in Chapter 4, I go to great pains to disaggregate those and then talk about their sum effects. Now, there's hardly anything out there that is more correlated with the stock market than net new change to cash flow for these two classes of funds. Unfortunately, they are not a leading indicator. They happen at the same time. And so you can't look at these cash flows and predict that the stock market's going up. But if the stock market's going up, you'll look at these cash flows and see it is being confirmed by increases in these cash flows. And when the stock market goes down, you know when you go back and take a look at this data that these cash flows turn negative. Now, what we're looking at here is not the amount tied up in the assets. We're looking at the delta. We're looking at the change in assets. So that's net new cash that's going into mutual funds. Now, if you think of it again at the micro level, suppose your parents have an S&P 500 index fund through Vanguard, and they have $200,000 in that mutual fund. That isn't reflected here. But if they decide to increase the balance in that mutual fund by $3,000, that's reflected here as plus $3,000. So net new cash in the aggregate going into equity mutual funds at the national level represents a very sizable new floor for the demand for stocks. Because if your parents add $3,000 to the S&P 500 mutual fund, it's run by Vanguard, Vanguard has to take that money and buy $3,000 worth of those 500 stocks. And therefore, that represents demand for those stocks.
And if you do it in a T. Rowe Price Science and Technology mutual fund, for example, then they have to increase the demand for the stocks that make up that mutual fund. So when there's new money flowing into mutual funds, for whatever reason that's true, that represents a surge in the demand for the stocks that make up the mutual funds. And so once again, that is a quadrant one phenomenon in terms of the little model that we developed, an increase in volume resulting in an increase in the price of the fund in question. Now, here's the record for mutual funds going through the 90, and the one that we really care about are the blue bar charts. The red, yellow represent all long mutual funds, and usually the spread between the two represents bond funds. But we're talking about stocks now. And so we can see through the 1990s, looking at the blue lines only, that money was flowing into mutual funds and was contributing to the boom in the stock market, the great bull market that lasted between 1990 and the year 2000. But when we get to the year 1999, it's at peak. But when we get to the year 2000, it has really shrunk. And when we get to the year 2001, it's actually negative. And there's no coincidence that that is correlated with the tremendous downturn in stocks that we saw. When we looked at the S&P 500, remember, for those 2 years, the S&P 500 fell to half its prior value. So in the 2 years where this little blue line is barely positive and then is negative, those are the 2 years when the S&P 500 collapsed. Then we saw again the recovery of the S&P 500 beginning in 2003, and coincident with that, we see again a surge in net new cash additions to equity mutual funds, and then boom, in 2006 it slows down, then 2007 is disaster, 2008, 2009, and 2010, and 2011 it continues to be low or negative. And of course, during those years, the stock market again had its second slump, and the S&P 500 again lost half of its value. But then we get to 2012, 13, and so forth. It takes off again, and then the market takes off with it. But finally, though, when we get to 2015, 16, and 17, the correlation breaks down that I've been describing. Because net growth to equity mutual funds in 16, 17, and 18 remains negative. And those were strong years, especially 2017. But as is explained in Chapter 4, this is because these new products, exchange-traded funds, which are substitutes for mutual funds, had appeared on the market and were beginning to be used in the place of mutual funds. And this reflects a loss in the relative popularity of mutual funds for this kind of investment and a growth in the popularity of ETPs to replace them. So when we go to the ET exchange-traded product river of money, we can see that part of the reason that the mutual fund cash flows turn negative is because these turn so sharply positive. And here we're looking at the red. And so we see 2012, 13, and 14, there was some growth. But what we really care about is what happened in 2016 and 17. Those were big growth years, right? So we go back and look at this and say, well, according to, history, the market should have been doing poorly because the stock market mutual fund net new cash additions were quite negative. But when we add ETPs or look at those alone, that's because they were making up the difference. In other words, your parents, your parents were beginning to substitute their stock or equity investments in mutual funds. They were beginning to substitute exchange-traded funds for mutual funds. And we'll see in the next two chapters, the reason why. Mutual funds are very, very good long-term investments for especially retirement accounts, but exchange-traded funds actually offer you much more flexibility and have favorable tax advantages. We're not ready to compare that difference yet. That happens after the first midterm, but at some point we will compare the two. And so the investing public, as you can see, all of a sudden began to disinvest a little bit from the Vanguard S&P 500 Index Mutual Fund and turn around and buy the tracking stock SPY, which is the ETF that tracks the S&P 500, as we'll see. And that's what we're looking at here. So the loss of popularity in mutual funds is explained by this substitution effect. So in the future, we have to look at the combined net new cash flow to these two product categories together to get a sense of it. And when we do, this is not in Chapter 4, I didn't have time to add it. Now we see that it's kind of explained. Now the red represents stock ETFs, and the green represents stock mutual funds, and the net, where the green is negative at least, the net is of course the red minus the green. It's not the length of the bar. But you can see things started to change actually in 2015, 16, 17, because in 2015, 16, and 17, stock mutual fund growth was negative. It's the same information we saw on this slide right here, same as there. But that was offset, especially in 16 and especially 17. Remember, 17 was a torrid, straight-up momentum, low volatility year, one of the best years for investment in stock market history in terms of stability. Well, ETFs were just booming in 2017. And then strangely, in 2018, they both again turned negative. And in 2019, the little box set there, looking at the monthly data, they continue to be negative through 2019. Now, you say, well, based upon this correlation, especially now that we've added ETPs, doesn't that imply that 2018 and 2019 actually should be market declines? And the answer, I would guess, without seeing the data for 2018 and 19, would say, yeah, this looks pretty substantial here, especially 2019, as you can see. Well, actually, 2019 looks about the same as 2018 in terms of where it seems to be going for the year. But the market hasn't been declining. Now, it hasn't been rising either, really, right? 2018 was a sideways, crazy, volatile year. 2019 has been the same. And although the trend through all this mess has been slightly upward, because the S&P 500 did indeed finally push through 3,000, it's only very slightly so. It keeps bumping up against that 3,000, then collapsing, then coming back up and collapsing. So it really is the case that right now, since 2018, we've been going through a volatile sideways market that only has slight upward drift. And of course, that slight upward drift can be erased in 2 trading days. 2 600-point trading days on the Dow would pull it right back down again, 5% or so. And so this at least reflects that weakness, but it doesn't reflect the strength that the market apparently has to at least hold stable, even if volatile right now. So when I looked at this, I'm saying, this is surprising me. The drawdown in 2018 and 19, because I haven't looked at this data since last year, seems to be larger than you would expect, given the fact that this market is not declining, right? Because this is a significant floor of demand. And when this goes away, and right now it's definitely not there, then what, in other words, is holding the market up? Retail investment, by the way, by your parents and yourself, maybe, and your grandparents directly in stocks is not very significant anymore. The retail investor has largely left the stock market, and it's relatively small in activity compared to where it's been in the past. People just generally don't buy individual stocks much anymore. And of course, you know the importance of retirement plans in the United States through 401ks. They're not even allowed to invest in stocks and the like. You can with a simple IRA, for example, but not a 401k. That's all mutual fund and ETF stuff. So this is never going to be because we've decided not to buy ETFs, that instead we're just buying the stocks directly. That's never going to be the explanation at the retail level. Some stocks are popular with small investors like Apple and Google and so forth, but the scale of the investment is quite small. So the question begs itself, where's the demand coming from right now to keep this market where it is right now? And I actually don't know the answer to that question.
I thought when I was preparing this lecture that maybe the answer really is in overseas demand for U.S. stocks. And the Wall Street Journal, actually the day after I posed that question, ran an article suggesting that was the case, and here it is right here. But the numbers don't look big enough for me to explain it. There has been a tendency for overseas investors on net to invest in U.S. stocks, mostly again at the institutional level. But the numbers they're showing here just aren't large enough to explain the relative remaining strength in the U.S. stock market. And so I'm not sure where that strength is coming from right now. This data on mutual funds and so forth has been very, very reliable in, again, not having any predictive power, but at least it's coincidental in that when the market's going up, you check the data, yeah, sure enough, the river of money's going up with it, and when the market starts to stall, sure enough, the river of money's coming down. But right now, it doesn't quite line up because the decline in the river of money would seem to me, given the scale of it, that the market should be going down rather than moving sideways at the present time. So I'm at a bit of a loss as to where the demand is coming from. Now, some of it I know is corporate, not only, of course, stock buybacks, which are sizable, but some corporate demand for other companies and the like. But I don't think that explains it either. I'm still just uncertain about what explains the current market. I think the market's on kind of skittery ground, though, because of these numbers. If retail investors aren't going into this market, even in mutual funds and ETPs, and this is the monthly data right there, the red lines, the most recent monthly data is July, then I think it's a dangerous market because of that. There's not really any demand floor out there that's coming from any source that I can understand. And the foreign stuff comes and goes. I mean, I don't know if you're watching the price of Bitcoin for right now. I look at it every day. It is downright bizarre how it's behaving. It goes up 3 and 4 percentage points, 5 percentage points a day, and you say, well, I think this is because of efforts in China to escape currency controls, and there seems to be kind of a flow coming from Asia into Bitcoins. It's bolstering all the big coins like Ethereum and Bitcoin without bolstering the small coins like Dash and Econ. And then all of a sudden today, the whole structure comes plunging down 18%. Everything, Bitcoin, everything, 18 to 20%. I'm saying to myself, what the hell is that? That's like hundreds of billions of dollars, of course, in nominal value of cryptocurrency in a single day, globally, across all the markets and all the coins, plunges 15 or 20%. Again, with no explanation at any level about why that happened. That's a significant loss of value for people who are investing in cryptocurrencies, right? So yet another giant question mark hanging out there about why these markets are behaving the way they do. How can you explain this mass departure? You know, you go to CoinDesk, which is really a good news source. They have nothing at all in CoinDesk that explains any of it. So it's a little worrisome to me when there's no stories about what's happening out there that make any sense. So now the book continues, other things that matter. We talked about mergers and acquisitions, and I was hoping to use a newer example, but it's kind of funny why I didn't. This is the DreamWorks animation story when Comcast bought them in 2016. You can see how much money was made. And this is the same example, unfortunately, that I'm using in the chapter. I usually try to give a newer example in the lecture. And the example I wanted to give was the IBM purchase of Red Hat. And I swear, I got all the data, made up all the stock charts, and wrote the story up. And I sometimes do that in a modular sense to later add to the chapters in the book. And I misplaced it. I don't know what the hell I did with it. I looked for it for 2 hours. I remember writing it. And unfortunately, the data has now disappeared because Red Hat was delisted after they were bought by IBM. So I can't go back and show you what happened to Red Hat's price between the day IBM made the offer and the day that the offer was executed. But it was something like the stock doubled. And a lot of mudders worked for Red Hat. A lot of famous mudders worked for Red Hat, like Sage Wheel. And famous at least in the Linux community. And so they were all made into multimillionaires many times over because of their stock holdings of Red Hat. So it was a great day when this happened. But unfortunately, I lost the damn write-up, and with it went the data, so I gave up on my effort to find it. So maybe someday it'll pop up somewhere on one of my machines. I mean, I misfiled it, obviously, under some obscure... Or the trouble with Windows, I hate Windows so much, I hate Microsoft so much, it's hard to control my passion. I might start frothing at the mouth here if I talk about it, but when you navigate through Windows 10, you can accidentally drag a folder out of its position, and it just throws it somewhere. And again, if I have 3,000 or 4,000 folders in my structure, it's out there somewhere in folder land. That doesn't happen in Linux. So DreamWorks Animation, the point is $25 a share and you're happy and you own it. Say you have 1,000 shares, $25,000 worth of this. And then all of a sudden you wake up and you look at the stock charts and your investment's worth $40,000. Because when these companies make a acquisition offer, it's often at a pump in the stock price of 60 or 70%, and the pump in the stock price of Red Hat was 80%. And so anyone who had bought Red Hat just before the IBM acquisition announcement made a lot of money. It's often the case that if they say we're going to we offer $45 for this stock, the stock won't go to $45. It might go to 40 or 39. As I explained, because there are so many regulatory hurdles to these mergers, there's a possibility that the merger won't be allowed. And so the price comes tumbling back down. So it doesn't go to the acquisition cost. But it's the dream to figure out who's going to become an acquisition target and buy the stock if you can figure that out, because you're going to make a lot of money if you do. I had dinner last night with Edith Harbog, who's a mud entrepreneur who built the company Lunch Darkly, which itself is worth, $150 million or so. And so they're very successful, and she's beginning to prep the company for an IPO. So I was asking her about GitHub, because, GitHub was built by a mudder, and I never knew who it was because I figured it was a mudder who had graduated, an older mudder who graduated before my time, but it's not. She told me who it was last night. And he would have graduated in 2001. His name's Preston. The last name is Preston. He would have graduated in 2001. He came here in 1998 or whatever when you graduate in 2001. And so he knows Edith Harbog quite well. Now, he is worth like $600 million because when Microsoft bought GitHub, he owned about 70% of the stock, and all of the acquisition price went to him. So this is a great story, right? He came to Mudd, and he didn't like Harvey Mudd because he thought the physics classes were too hard. This is what I never heard this story before. He got pissed off. He said, there's no reason for physics to be this hard. I'm smart, but I'm like in pain, and I'm not going to put up with this. So he came back in the sophomore year and was going to go to Mudd, and he said, screw it, this college is ridiculous. And he dropped out. And I had heard that part of the story not long ago from Josh Jones, but I didn't know where he went. So where he dropped out to was Andrei Abraменko's Infostry, for which I was a director. And so in my Enterprise and the Entrepreneur class, I tell this really interesting story about how Infostry exploded in 1999 and was this disastrous Enterprise and the Entrepreneur failure, a disastrous Mudd failure. It just went down in flames like smoking black hole failure. And I had no idea that Preston worked for them as an employee, as a coder, an Oracle coder apparently. So I knew him, but didn't remember that I knew him. And so he lost his job because of Infostry exploding. And I was part of the reason Infostry exploded. I made a mistake in advising the company, and actually the failure to advise them to do something. They didn't do it, and the company failed because they didn't take the advice I didn't give, basically. So I now feel partly responsible for GitHub existing because he was unceremoniously booted out of Infostry because all the employees were
And right after that, in a brainstorm, he started thinking about version control of software, and GitHub was a result of that. And now he's worth $600 million, and he's a mud dropout. So I thought you would all appreciate that now that you've spent 4 years slaving away going to mud so you can get your $65,000 a year job. So part of this story of the upper 1%, what does it take to enter the upper 1%? Start mud, but don't finish, I guess is the answer. If you and just give up because physics is too hard. That's what he emphatically said. Yeah, that's why he dropped out. He said, physics is just too hard at mud. It's not rational. So continuing on, lower back down to the ground again. Yeah, but he is a mudder, The GitHub thing, he's a mud guy, right? He was a mudder here to the extent he was anything. So dividends, of course, as it points out, plays a significant role. And this is dividends by sector, 2018. I couldn't find it for 2019. So a lot of people and a lot of long-term investors make dividend purchases. I often advise students to kind of get into dividend stocks because they really do well in the long run. And I say to students, if there's a downturn going on, and the markets really look bad, but you're saying, just like every other time, I know there's going to be a bottom, and if I get in the bottom, then I'll look really, really good. Like if I had bought stocks in 2003, 2004, oh boy, would I have done well. If I'd bought stocks in 2009, 2010, oh boy, would I have done well. But I've also pointed out to you that you cannot pick turning points. And so if you're thinking about getting in because you think it's near the bottom, you're definitely not going to be sure that it is. It could be false positives and false negatives, right? You may not be sure that it is. So if you're in doubt, buy dividend stocks. And it won't matter so much then because dividend stocks will be paying typically really high yields in the slump because many companies don't reduce their dividend, but their stock price has fallen, so the dividend yield is way up. So then if you're wrong on the timing, you are nonetheless picking up a dividend stock that pays 6 or 7% as opposed to 2 or 3. And if you're right on the timing, then you get a dividend stock paying 6 or 7%. The stock rallies back up, it doubles in value, and you're still earning 6 or 7% on the basis of your investment, plus you've got a capital gain. So if you want to play the turning points, start playing the turning point on the way back up by searching for what they call dividend aristocrats. Now, to give you an example of that, my wife and I do that, especially my wife. She likes dividend stocks. And she bought dogs like Ford. And you say, who would ever buy Ford? Ford doesn't even make cars anymore. They're such a loser company, right? They just make their F-150 and that's it. And, well, they make more than the F-150, but that's pretty much the only thing they sell. But Ford stock actually went to $1 after the mortgage market collapse. $1. Ford was the only automobile company that was not slated for bankruptcy after the mortgage collapse. All of the other automotive companies were bailed out by the U.S. government. Otherwise, every single one of them would have gone bankrupt. Ford, however, had a nice cash position. They kind of anticipated the downturn. They didn't get a bailout. Didn't do much good, but the stock nearly did go to zero. It went to $1, but it stopped at $1. They kept paying their dividend. So the dividend yield on Ford was like 12%. We bought a lot of Intel. The dividend yield on Intel when we bought it was 12%, right? They had not cut their dividend and the stock had fallen by 60%. Ford rallied back up to 12 and, we sold it for that. And then it's kind of, collapsed back down and out. And Intel doubled or so, and we sold Intel as well. So we did get the timing right, but even had we not, we would have had a really nice dividend as the market continues down. So dividends can play a significant role even in an aggressive portfolio if you're even playing the market. That's, again, when you start to move back in with dividend stocks because you can take advantage of the higher yield if you're wrong about the turning point. Now, S&P 500 dividend yields here, you can see that these have come and gone. and the average is 2.20%. As it says in the book, something like 420, I forget the exact number, but the chapter has it. Of the 500 stocks in the S&P pay some dividend or another, so dividend payment is a big part of it now. 2.2% isn't all that high, but it's as high as a 10-year Treasury note yield is right now. And of course, if these stocks have capital gains, then you get the capital gain in addition to the dividend. Once again, this spike, we've had two spikes, they have the same. This is actually the point that I was just making about the early investment. See that spike right there? When is that spike? That's 2009 or 2010. It amplifies what I just said a moment ago, right? It's a spike because the denominator, this dividend yield, of course, is a dividend divided by the price of the stock, right? The denominator collapsed because stock prices collapsed. The dividends didn't. Many of these companies kept paying the dividend, so the dividend yield spiked. Right there, see where it's 3% or 3.5%? So, of course, for some companies, the dividend was 6, 7, 8, or even 10%. That's what I'm talking about. And so you went in there and you move and you buy it there, then great, you've locked in a big dividend. And then if you're right about the stock market reversing its direction, then you get capital gains on top of that. So that spike there in 2009 is an anomaly caused by the fact that dividends were preserved while prices collapsed. And then when prices recovered, the spike goes away. So that's a great lesson for you. Just remember, when everybody is rushing out of the building, you rush into the building. Okay? And when everybody's rushing into the building, you rush out of the building. If everybody's just sort of sitting in the building or sitting outside, then you sit in the building or sit outside. But when people start rushing, you wait to make sure the rush is really, really, really unidirectional, then you rush the other direction. And you'll be just fine. You'll be just fine. When the news media is panicking, is this going to turn into a depression? Then you say, well, they start using words like depression. We must be near the bottom. So I should think about loading up, right? Unless we are near the depression. But if that's true, then it's over anyway. So, now stock buybacks are scandalous, actually, and I talk about that some in the chapter. This is Apple buying Apple stock, Citi buying Citi stock. This week, Oracle's making large purchases of its own stock. So some of this explains why the market keeps going up. These companies generate so much cash because they're cash cows. They use that cash to buy their own stock, specifically for the purpose of supporting the price. And so it, of course, represents a floor. It's just another source of demand. It's also hugely beneficial to the executives in the company who are paid in stock. A lot of stock compensation at the executive level. A lot of employment compensation is in the form of stock rather than cash. So, of course, if you pump the price of the stock, then that makes all the executives rich. You can see, once again, it turned down in 2009. Boy, this is really getting predictable, isn't it? Everything rallies when the markets are rallying. Everything turns down when the markets turn down. The peak there, right there in 2018, where it seemed to be $1 trillion, that's a lot, right? $1 trillion of stock buybacks by corporations buying their own stock in one quarter, not in 1 year. This is quarterly data. And so that peak right there, that's the effect of the capital gains tax act that was passed by the Trump administration. It made corporations so much money that they went on this stock buying spree. Now, that was going on a year ago. So in this class, what we did is we looked up the names of companies who announced stock buyback programs, and we chose one to buy, seeing if we would make any money on that company because of their stock buyback program, and we chose Oracle. And we didn't make any money. Oracle continued to fall despite the fact that they engaged in a very aggressive stock buyback program. That tells you, however, that it would have fallen even more had they not engaged in the stock buyback program. So maybe to some extent, some of this tendency for the prices of stocks to kind of come back up after they have their 5 or 6 or 4% decline is due to companies actually buying their own stock back. Because it still continues. There is a reference in the chapter
that shows the weekly data, it still continues at a torrid pace, even right now. I mean, nothing like right after they passed that capital gains tax relief, but as you can see, it still continues at a very high pace. So maybe that explains some of it. And we do know, by the way, that small caps aren't doing as well as the S&P 500. We looked at that really early on in the course, at least not right now. And small companies aren't doing stock buybacks because they don't have the cash to do it. It's the big giants that are doing it. So maybe, that explains a little bit of it also. Obviously, all of the top 30 in the Dow can afford stock buybacks. So maybe that. This is an example of the weekly market beat, and that if you want to look at it, just look at that URL down at the bottom. And this is actually the monthly. You can see there Microsoft. And they're not buying small amount. Microsoft is buying what percent? 4% of their own shares. That's a lot, right? They're buying 4% of their stock back, and they announce it. They have to announce it before they do it, so they do. And the rest of the Oracle's there. Oracle's buying 8%. Oracle we bought last year because we were buying 12, and Oracle stock actually didn't go up. Despite that, we bought it thinking, well, it'll go up because they're going to buy their own stock. But basically, what they did was, I guess, stop the decline in their stock, because we didn't lose much on that either. We just didn't make any money. And so this is Microsoft. 9/18/2019, Microsoft says we're buying back 4% of our stock. So that's narrowing the base, too. That means less stock is available for trade. And given that these large super corporations are buying big chunks of their own stock, maybe that is helping to explain why the market continues its resiliency. Okay? And maybe not. I'm not sure why the market's not faltering more at the present time. In the case of Bitcoin, by the way, I know from discussions with Josh Jones that major players traditionally have gone in to manipulate the market effectively by making very large, basically repurchase agreement type trades where they say, we'll buy if you'll buy back. We'll buy if we'll buy back. They pump the stock up and pump it back. But that's used to explain why the stock pops 3 or 4%, not why it declines 15%, right? So Wired Magazine about 4 years ago had a big article about evidence they uncovered from efforts to manipulate the Bitcoin market, and 2 of the people involved in the article were mutters. They weren't Josh Jones, they were other mutters based in San Diego that I knew. Was it illegal? Nobody knows, because that's an unregulated industry right now. Is it illegal to manipulate Bitcoin prices? These days it probably is. I would say 2007, not 2007, that's too early. 2014, I'm not sure. Okay, momentum markets. Momentum markets can happen, and this sort of violates the efficient markets hypothesis that markets are efficient. Remember I told you that markets do price very well. They do seem to respond to information correctly. I'm impressed with how well options are priced, for example, given the price of underlying, because I track them at a level that not many people do because they're being tracked by algos that I wrote. And so momentum markets and what they call mean reversion markets aren't even supposed to happen. They're not supposed to logically be possible. But momentum markets do definitely happen. And the market from 1995 to 2000, or at least to April 2000, was a wild, crazy momentum market. And the buildup for the 2000 crash, and the story I'll tell you will be about the 2000 crash, begins with a momentum buildup from 95 to 1999 that was completely out of control. It was just like the Bitcoin buildup, just ridiculous. Prices rising to completely irrational levels. Now, this happens for a number of reasons, and part of the dot-com crash, or what led up to it, was the hype associated with the technology, associated with the, quote, World Wide Web, right? The tsunami of bullshit about what the World Wide Web was going to do. And it turns out that the promises were actually accurate in terms of how it would change things, because that turned out to be true. It's just that 4 or 5 corporations would share in the bonanza of that, and nobody else would, for the largest part. That's why some made it. Amazon made it, and eBay made it, eToys didn't make it, Ventro didn't make it, the companies I'm going to talk about in the video lecture didn't make it. And then later on, Google made it, but Google's kind of a late comer to all of this. Google wasn't in the early phase of it. Well, what happens here, sometimes excess speculation can push stocks up at exponential rates into ranges that economically make no sense. You just can't justify by any standard price to earnings ratios being 30 to 1, or in the case of technology stocks, as I said, 70 to 1. There's just no way you can justify it rationally. For this to happen for an individual stock, an entire industry, or an entire market, it's happened in cryptocurrencies a number of times. It's happened in tulip bulbs. It's happened in railroad bonds. It's happened in South American bonds and so forth. For the stock market as a whole, such a cycle usually begins when stocks are undervalued for a long time. And really, the speculative boom that happened, that turned into the momentum market of the 1990s, begins with the inflationary market that I've already told you about of the 1980s. Right? I said prices didn't rise. The Dow Jones, right? We looked at the Dow Jones. It was the same in 1982 as it was in whatever that started, 1971 or whatever it was. Same level, 808 or 806 or whatever that number is I showed you. But the economy was doing just fine. It was growing. Corporation profits were going. We had an inflationary episode that was quite serious and did a lot of damage. But some companies were flourishing. General Electric was making money hand over fist back in those years and was a growing company doing quite well. There were large numbers of corporations, the newly emerging microcomputer market then, the first of the companies like Prime and DEC, and all of those companies were absolutely flourishing in the 1980s when I just first came here as an assistant professor. And yet stock prices were stable. And so these companies ultimately, after 10 years of no prices rising, were actually substantially undervalued. They should have risen some because the companies were doing well. And so there was some catch up like this little graph implies. It should have been rising like the red line, and the reality was a blue line, so prices start to rise. But when prices start to rise, that means they're rising at double or triple the rate of the underlying economy, and that gets noticed by people because it's a 7 or 8 or 10 or 12% rate of return, and if it's leveraged even 2 to 1 with a margin account, it's a 20% rate of return. So more and more money flows into it because of the high rate of return, and the high rate of return compounds because more money is flowing into it. This can go on for a decade, and the thing can practically start going straight up. So at the very end, prices are rising 5% a week on some stocks or more. I mean, some of the individual price movements in 1998 and 1999 were ridiculous. I mean, 5%, 10% a week or so. Stocks going up $5 and $6 a day, moving into 3 and 4, 500, 600, splitting and so forth, day after day. And the momentum, therefore, of just cash flowing in and quick profits being made was propelling the market. And the market got nervous because they knew it was irrational, so it would come crashing down and it would stop and go right back up again. So there's always this long period of kind of crazy instability before it goes up the one final time, and then boom. That happened, by the way, in 1929 also. The stock market crash really is sort of registered as starting on October the 29th, 1929, but only because that was the peak. A price very close to that was hit in March of 1929. And so all during the late spring and summer and early fall of 1929, the market was going up and coming down, going up and coming down, going up and coming down. So finally it went up one last time, hit its peak on October the 29th, 1929, and then lost 80% of its value. So these momentum markets, the only operative term at the end is momentum. So obvious and well-publicized profits being made attracts more money, which results in more demand, which causes prices to accelerate. Sometimes the rise is exponential in the final phase before the correction, which is often a collapse. And that chart right there is an actual chart of the NASDAQ during the period of time in question. That little spike and fall, of course, is lost in modern day that carries up to the present because the index has risen so much since then. But if you look at the index from the period of time shown there, ending in, say, 2004, that's what the NASDAQ looked like. It climbed a mountain and then just completely and utterly collapsed. And the NASDAQ, of course, fell far, far more than the S&P 500 or the Dow because the NASDAQ was tech heavy and the tech stocks really took it. There's one more. So momentum markets are always a possibility. Bitcoin has seen momentum markets before. If you see a momentum market, there's no reason for you not to go along for the ride. So long as you recognize what you're getting into, get in and be willing to get right back out. You've got to get out before it collapses. Now, I have made the mistake always of recognizing momentum markets, but I get out too early. I knew the crash was going to happen in 2000, but I knew it in 1998, and that's when I sold all my stocks. So I didn't ride through the last 30% rise. And I actually made up finally because they went below what I sold them for finally in 1998. But I could have made another 20 or 30% had I had a better sense of timing on it, right? So I did catch the rebound in 2007, though. 2009 to the day. I went to an entrepreneurial network meeting, and on an impulse, I said to everybody in the meeting, said, buy stocks starting now. And the day I said that was the trough. I swear to God. Of course, I was just showing off. I'm not telling you about the times where I've said things like that and I was wrong. Now, in 1987, we'll stop with that. And then, as I say, the rest will continue in the video because it's about the .com. And I want to elaborate on that so it's not in a brief little story because it's relevant. The 87 program crash, this was a computer going crazy, like war games. This is a computer, or a group of computers actually, a network of computers crashing a stock market all by themselves. And to this day, nobody's quite sure how it was done. It was like the flash crash. Kind of understood, but not entirely understood what the mechanics were. This is still controversial. It was program trading. It did start in Hong Kong and was a long overdue reaction to a heated market, but the October 19th, 1987, 2,700, and of course that was after, this was during the momentum phase. This is one of the setbacks in the momentum phase, right? In December 85, it was 1,500, it goes to 2,700. That's a pretty torrid pace for a 2-year period, so the market was overextended. But it crashed back down to 17, and then by 1989, it was right back up to where it had been before. Now, it was definitely triggered off by computers, and computers were trading, they were doing arbitrage in S&P 500 basket of stocks versus the S&P 500 futures contracts. And the computers all were using the same program, they all had the same threshold conditions, and they all had a flaw that was only recognized after the crash had happened. But again, it was one of these things where the demand side just shuts off across the board because all the computers shut down at the same time, and there was just a free fall of the non-computerized trades on the first day. And as I say, that started in Hong Kong, so it just set off people unloading portfolios after that to respond to the first day, and it didn't stop until it hit 1,700, and then it stopped. And then the rally literally resumed. Now, nobody who was trading through this knew it was going to do any of this. Nobody who knew it was going to fall that far. Nobody who wrote it down knew time to buy and it's going to go right back up. Everybody in retrospect saw what happened, but nobody at this time, because I remember this vividly when this happened. It looked like the end of the world at the time. But I thought it was very cool that basically it was quant programming that was ultimately responsible for this, right? You design your little programs to jump in and out of the trades, but you got a threshold condition there, or you lack a threshold condition that should be there. The failure, and you're all using the same model is actually the problem. You're all using exactly the same computer program. So you've got this aggregation issue, and so the computers all decide to stop trading when the threshold condition is passed, and boom, the bid queues all go black. And then the rest of the market, the physical part of the market, which was substantial back then, just panics, and the game is over. Maybe that's what happened in Bitcoin. I know increasingly it is algo traded, because I read about it on the Reddit subreddit, that talks about the application of algo trading to cryptocurrencies and the like. So maybe there's probably a common model out there that people are using, and maybe it just shut off yesterday or something. These 15% declines that happen in all markets instantaneously, I always suspect machine trading. And just like James Cameron envisioned, I actually talked to Cameron about this. It's how the world's going to end. That's what he was trying to tell us in Terminator 2. So you realize that's a message from Cameron, don't you? It wasn't just a movie. So, I was there when it was filmed. I talked to Cameron. I knew Stephanie Austin, the line producer, was a good friend of mine. So Cameron and I hung out back in those days. So, okay. So you can go now, and I will tell you the .com story, the 2000 part of the crash, which is represented in the slides that continue here in the video. It's only 20 minutes or so, and it's interesting. I talk about all these companies that go from 18 to 300 to 0. That's always interesting to read about. You just want to make sure you avoid it if it happens to you. Meanwhile, if any of you can tell me what's going on with the repurchase market agreement, I'd appreciate your comments. If you can tell me what's going on with the cryptocurrency market, I would appreciate your comments, because I need to know.
I have a quick question.
Yeah.